Can you make 7 figures in a business and pay $0 in income tax without a single write-off and without purchasing real estate? The answer is yes. And not only that, but you can do it without any personal risk or liability. Today, I'm going to show you exactly how you can do just that. The way that you can pay $0 in income tax without write-offs, without real estate, and without any risk or liability is through what we call the Billionaire Legacy Blueprint. Now, what I want to do today is I want to give a brief overview of how the system works, and then I will dive deep into the tax code and the definitions behind the tax code. That way you can gain a deeper understanding of how this actually functions and move with confidence knowing that you're not at risk to be audited and you're not at risk for tax fraud. The first thing that we do within our system is we set up a family trust. Now, this trust is set up with you as the trustee and your family as the beneficiary. Just like all of our trusts, this trust is irrevocable, complex, non-grantor, discretionary, and has a spendthrift provision. Now, each one of those is pillars that puts us in a certain category and allows us to use certain language within our trust that will ultimately put us where we want to be with the IRS so we can ultimately pay $0 in taxes. Now, the second thing we do is we set up this business trust. Again, you're the trustee and your family trust will be the beneficiary. And what this trust does is it handles all your active income. So we have business trust with your active income. The beneficiary is your family trust that handles all your passive income and holds all of your assets. Very simple. These two trusts work perfect in tandem with each other. Additionally, we have a 508c1a trust that we set up. Again, you're the trustee, the beneficiary, also your family trust. And the really cool thing about the 508c1a is not only does it not pay taxes, but it doesn't even have to report income, it doesn't have to file, and it doesn't have to register with the state. And I'll break that down line by line so you can gain a full understanding. But this blueprint ultimately lays out how our system functions. Now, from a tax standpoint, how does this work? Your active income will flow into your business trust, and let's just say that was, for easy numbers, $100,000. In this scenario, there's no business expenses associated with this trust, so that $100,000 at the end of the year will get distributed to your family trust through a K-1 distribution. Now, because you're doing a distribution, this business trust zeroes out. It would pay taxes at 37%. We distribute all of that $100,000 to the family trust, zeroing out the balance sheet and the bottom line for this business trust at the end of the year. So therefore, the business trust does not pay taxes. Now, the family trust receives all your passive income, so anything associated with capital gains, any other passive income, or K-1 distributions, and it receives those and uses those distributions to account for any trust expenses. So going into trust expenses, very simply put, anything but food, fun, and fashion for trustees. So very, very simple. If it doesn't fit into that category, then it is a trust expense. So going from there, some examples of trust expenses. Anything that is associated with your house, your cars, any life insurance policies, car insurance policies, and anything that the beneficiaries would need. Now, at the end of the year, let's just say out of that $100,000, $80,000 of that went to trust expenses and was expended. So just like a business, all of those expenses will be deducted from the bottom line. So at this point, you only have $20,000 in what would be considered taxable income. Now, at this point, the trustee or our accountant will declare this last $20,000 as an extraordinary dividend. Under IRC 643B, extraordinary dividends can be deferred in perpetuity. Now, basically what that means is it's not that we're not paying taxes on it, it's that that money is allocated to corpus and deferred in perpetuity. And I'm going to break that down line by line what exactly that means. But for now, Those gains are deferred, as well as any capital gains, declared extraordinary dividends, and therefore zeroing out the balance sheet at the end of the year, and the trust will show no income, active or passive. Now moving to the 508c1a trust, this trust simply does not pay taxes. It is completely tax exempt and it does not file a return, so there's no need to do anything with that. It takes care of itself. Now, diving into the tax code, let's take a look at 26 USC section 643. Definitions applicable to subparts A, B, C, and D. As I mentioned, active income flows into the business trust. At the end of the year, a K-1 distribution will distribute that money down to the family trust. Whatever is left over, let's say $20,000 out of $100,000, trustee or accountant will declare that $20,000 as an extraordinary dividend, and therefore it will be allocated to corpus and not taxable, aka deferred in perpetuity. So let's go through that. A, distributable net income. For purposes of this part, the term distributable net income means, with respect to any taxable year, the taxable income of the estate or trust computed with the following modifications. 1. Deduction for distributions. No deduction shall be taken under Section 651 and 661 relating to additional deductions. 2. Deduction for personal exemption. No deduction shall be taken under Section 642B relating to deduction for personal exemptions. Now this is key. 643A3. Capital gains and losses. So this section right here is telling us what we can do about capital gains within our trust. Number 3, capital gains. This is telling us exactly what we need to know about the capital gains within our trust. Let's read it. Gains from the sale or exchange of capital assets shall be excluded to the extent that such gains are allocated to corpus and are not paid, credited, or required to be distributed to any beneficiary during the taxable year, or B, permanently set aside. So let's break that down. Capital gains from the sale or exchange of capital assets, real estate, crypto, stocks, shall be excluded. So gains shall be excluded to the extent that such gains are allocated to corpus and are not paid or credited or required to be distributed to any beneficiary during the taxable year. Let's break that down. Are not required to be distributed to any beneficiary during the taxable year. Our trust is set up as a complex trust, meaning it is not required to distribute any assets to any beneficiaries during the taxable year or at all ever. So we qualify there. Second, again, let's read this. Gains from the sale or exchange of capital assets, real estate, stocks, crypto, shall be excluded to the extent that such gains are allocated to corpus. Let's look at some definitions here. Let's look at the definition of excluded. Exclude. To remove from consideration or rule out. So, these capital gains are not being included in what we are required to pay tax on. In this scenario, capital gains shall be excluded to the extent that such gains are allocated to corpus. Okay, so what does corpus mean? So it's saying that the capital gains will be excluded so long as they're allocated to corpus and not distributed. So we know they're not going to be distributed. So let's look at the definition of corpus. What is a corpus? Corpus is a Latin word for body, which can have several meanings, including referring to the body of the prisoner in the context of criminal law. In the context of trust law, this is us. Corpus means the property or premises of a trust for which the trustee is responsible. So let me break that down for you. Allocated to corpus means simply allocated to the body of the trust, meaning all you have to do is leave those funds in the trust bank account. That's all that means. Very simple, very straightforward. So let's take a look at what complex means. Since we have a complex trust, we need to know exactly what that means. Taking a look at complex trust. A complex trust is one that does not fulfill the IRS conditions of a simple trust. Let's take a look at simple trust. A simple trust is one of three general types of trust that must meet three requirements set by the IRS. Number one, all the income must be distributed to the beneficiaries yearly. Okay, so we know we are not a simple trust, and a simple trust, based on that definition, does not qualify for the tax code that we're talking about. We're a complex trust, so let's look at complex. Again, a complex trust is one that does not fulfill the IRS conditions of a simple trust. The expression complex refers to the trustee's discretion rather than the trust provisions being more complex. A complex trust must engage in at least one of the following three activities each year to be regarded as such. The trust must keep part of its income rather than giving it all to the beneficiaries. Very simple. The trust must keep part of, or all of its income. And so, again, IRC 643A3, gains from the sale or exchange of capital assets shall be excluded to the extent that such gains are allocated to corpus and are not paid, credited, or required to be distributed to any beneficiary during the taxable year. That's just simply saying that $20,000 that is left over at the end of the year will not be distributed to beneficiaries. It will be allocated to corpus, whether from the sale of capital assets or whether it be from additional income that was left in. It doesn't matter. Let's just say, for example, you put $100,000 into crypto, you come 6 months later and you pull out $500,000. Now, what you have is a $400,000 capital gain. But gains, that $400,000 from the sale or exchange of crypto, shall be excluded to the extent that such gains are allocated to corpus and are not paid, credited, or required to be distributed to any beneficiary during the taxable year. Very simply put, that $400,000 capital gain can be spent on trust expenses, no problem. As long as you're not distributing cash to your beneficiaries, or you're not distributing cash to yourself, at least not through a K-1 distribution, then those capital gains are totally safe and non-taxable. It's right here in the literature. Moving on. Or paid, permanently set aside, or to be used for the purposes specified in Section 642C, losses from the sale or exchange of capital assets shall be excluded except to the extent such losses are taken into account in determining the amount of gains from the sale or exchange of capital assets which are paid, credited, or required to be distributed to any beneficiary during the taxable year. The exclusion under Section 1202 shall not be taken into account. So that is very simply just laying out the fact that, let's say you take a $500,000 capital loss, $1 million capital gain, you're left with a $500,000 capital gain. That wouldn't be affected. You would just simply allocate that $500,000 to corpus under IRC 643A3, capital gains and losses, and the rest is history. And so what happens with that capital gain is it's not that you're not paying taxes on it. It's that we are letting the IRS know that we did have a capital gain. However, those capital gains, under the discretion of our trustee and in accordance with our tax advisors, we will be allocating those funds to corpus, meaning we will be deferring them in perpetuity. That doesn't mean that you're just all of a sudden have a magical capital gain that you don't have to pay. It means that you're deferring it in perpetuity. So what does deferring in perpetuity mean? Taking a look at perpetuity. Perpetuity means something that continues indefinitely. In finance, this can refer to an annuity, rather a cash flow that continues on forever. As stated by finance formulas, a perpetuity is annuity that is paid out in periodic payments for an infinite amount of time. So what this is saying, this is the most important part right here. Perpetuity means something that continues indefinitely. So, by definition, what we will be doing is indefinitely deferring taxes. So, we're going to make $500,000 this year. We're going to defer that in perpetuity forever. IRC Section 643A4, Extraordinary Dividends and Taxable Stock Dividends. For purposes only of Subpart B relating to trusts which distribute current income only, there shall be excluded those items of gross income constituting extraordinary dividends. So extraordinary dividends shall be excluded and deferred in perpetuity, or taxable stock dividends which the fiduciary acting in good faith does not pay or credit to any beneficiary by reason of his determination that such dividends are allocable to corpus under the terms of the governing instrument and applicable local law. Now, let's talk about that. Again, the fiduciary, it's going to be the trustee, acting in good faith, we are acting in good faith, does not pay or credit to any beneficiary by reason of his determination. So this is a discretionary trust, so he is to determine that such dividends are allocable to corpus, again, the body of the trust, under the terms of the governing instrument and applicable local law. Very important. Allocable to corpus under the terms of the governing instrument and applicable local law. The governing instrument is the trust itself. So this is where it is very important. You can't just go buy any trust. You can't just go to any random person and set this trust up, because according to the tax code, the trust has to align with the wishes of the trustee, meaning that the terms of the trust and this governing instrument, which is the trust, must align. So the certain verbiage that we're looking for, that it is okay, and this is a discretionary trust, this is a complex trust, and these gains and incomes and extraordinary dividends can be deferred in perpetuity. The trust has to say that. So that's where it's very important. Moving down, IRC 643A5, tax-exempt interest. There shall be included any tax-exempt interest in which Section 103 applies, reduced by any amounts which would be deductible in respect of disbursements allocable to such interest, but to the provisions of Section 265 relating to disallowance of certain deductions. That doesn't apply to our trust. Going down to a foreign trust, we are not setting up a foreign trust. Moving down to abusive transactions. The Secretary shall prescribe such regulations as may be necessary or appropriate to carry out the purpose of this part, including regulations to prevent avoidance of such purposes. If the estate or trust is allowed a deduction under 642C, the amount of the modification specified in paragraphs 5 and 6 shall be reduced to the extent that the amount of income which is paid, permanently set aside, or to be used for the purposes specified in section 642C is deemed to consist of items specified in those paragraphs. For this purpose, such amount shall, in the absence of specific provisions in the governing instrument, be deemed to consist of the same proportion of each class of items of income of the estate or trust as the total of each class bears to the total of all classes. Again, this is just saying that we need to be certain we are only using trust funds on legitimate trust expenses, and that the provisions in the governing instrument align and tell us that it's okay to go ahead and do this, which ours does. Now, moving down to 7B, income. This is very, very, very crucial. For purposes of this subparts B, C, and D, the term income, when not preceded by the word taxable, distributable net, undistributed net, or gross, means the amount of income of the estate or trust for the taxable year, determined under the terms of the governing instrument, again, determined within the literature of the trust, within the governing body of the trust. What does the trust document say? What does the statement of purpose say? Does it give us the ability to do this? Is it truly a non-grantor, irrevocable, complex, discretionary spendthrift trust? In our case, it is, under the terms of the governing instrument and applicable local law, items of gross income constituting extraordinary dividends or taxable stock dividends, which the fiduciary, acting in good faith, determines to be allocable to corpus under the terms of the governing instrument and applicable local law shall not be considered income. Let's break that down. Under the terms of the governing instrument, meaning, what does the trust itself say? The governing instrument is the trust. So under the terms of the trust and applicable local law, which we are set up under the Constitution of the United States, the unratified Constitution, items of gross income. So this is your active income, your gross income, whatever's left in that trust that is being distributed to the family trust. In this case, $20,000, as we discussed, constituting extraordinary dividends or taxable stock dividends, which the fiduciary, acting in good faith, determines to be allocable to corpus. This K1 distribution coming in from the business trust into the family trust, which the fiduciary, acting in good faith, determines to be allocable to corpus, allocated to the body of the trust bank account, not required to be distributed to any beneficiaries, under the terms of the governing instrument, the trust, and applicable local law shall not be considered income. What's happening here? The fiduciary or trustee of the trust is taking whatever's left over. In this case, $80,000 of that original $100,000 distribution went to trust expenses. Now, the fiduciary, the trustee, with the help of our accountant, with the help of your accountant, is going to defer whatever income in perpetuity. That's all that's happening. And we will defer it this year. We will defer it next year. We will defer it the year after. We will keep deferring it. As we defer income, this strategy works best by investing income into other assets and putting money into cash value life insurance. That is what the wealthy do. The reason being, money can go tax deferred into life insurance and it can be pulled out tax free. Just like someone who is using life insurance outside of a trust can take their post-tax money and put it into life insurance and then pull it out, and the gains that they pull out are tax-free. You can do the exact same thing with a trust. That is infinite banking at its core. The principle, the heart of infinite banking is the ability to put this money in tax deferred and pull it out tax free. Why? Because that money can be spent on any trust expense. Well, if the trust is the owner and the beneficiary of a life insurance policy, then the policy premium is a trust expense. Overfunding that policy is a trust expense. So the money goes into the trust as tax deferred, pre-tax, and it comes out tax free. This is the only way that you can keep your money. The only tax strategy that does not require you to part with your money. So let's take a look at LLCs, for example, because that's what everybody knows. That's what everybody's used to. Let's talk about it. An LLC, a limited liability company, not only does it offer you no asset protection, we already know that. There's no protection. The corporate veil has been pierced thousands, if not hundreds of thousands, if not millions of times. The corporate veil of an LLC has been pierced. LLCs are worthless. They are not protecting you. They are not doing anything for you. The current model is to use an LLC, which offers you no protection and no real tax benefits other than the ability to write things off, which is great because The trust, you can also write things off. The key difference with the trust is that we're not writing things off that we don't want or need. We're writing off legitimate trust expenses. And there's no rush or hurry to write things off. If we don't write it off, then we will defer that money in perpetuity, put it in a life insurance policy, tax deferred, and take it out tax free. It's that simple. I don't know why the gurus of the internet haven't explained this yet. Probably because they don't know, because the gurus on the internet are a bunch of posers. They don't know what they're talking about. They haven't gone in and read the tax code. And so to break this down, the LLC model, you buy things, you write things off, you purchase real estate to zero out the balance sheet, you're making stuff up, you're buying this that you don't want, you're buying this that you don't need, you're buying this that's really not even a write-off, and you're hoping to God the IRS doesn't audit you because that's what your tax accountant has done. That's what your tax accountant has done for the last 25, 30 years. There's no need. We don't operate in the gray area where we're hoping not to get audited. We welcome being audited because our books are legitimate. We are being 100% upfront and transparent with the IRS. Hey, we made $100,000 in this trust. We distribute it to the beneficiary. This trust pays $0 in taxes because it distributed all of its net income. Goodbye, gone. This is at a zero. Now, the family trust. How does the family trust work? The family trust works by paying for all trust expenses. It pays for the home. It pays for the beneficiary's clothing and food and education and transportation and shelter. So it pays for the home, pays for all expenses associated with the home, homeowner's insurance, electric bill, Wi-Fi bill, water bill. Your hot water heater goes out. It pays to fix the hot water heater. Your roof leaks. It puts a new roof on the house. It pays for your vehicles. Not only does it buy the vehicle, but it pays the insurance. It pays for the flat tires. It pays for the oil changes. It pays for the cracked windshields. It pays for the car washes. It pays for every single expense associated with the trust, including life insurance. The trust owns the life insurance policy, then guess what? The premium is a trust expense. It's that simple. Money goes into the life insurance policy. Whatever's left over, deferred in perpetuity, and you can load it into the life insurance policy, overfund it, and then take it out, either borrow against it or actually take it out tax-free. All while getting that death benefit and the ability to be your own bank and have that cash value that's going to be growing exponentially. So no, we are not operating in a gray area. Our accountant that we have on staff has filed nearly 12,000 tax returns and has never been audited a single time. None of my clients have ever been audited. I've never been audited. And the reason we've never been audited is because we're not in a gray area. We're not hiding anything. There's nothing to hide. When we fill out our tax returns, we let the IRS know every single last dollar that we spent. They are in the know. There's no gray area. We're not hiding. We're not pulling a fast one. We're not pulling the covers over the IRS's eyes. They are 100% in the know what we're doing, and what we're doing is following what the tax code says we're allowed to do. We're simply spending money pre-tax on trust expenses and deferring whatever is left over in perpetuity. It's that simple. And so that is the business trust and the family trust in a nutshell. Well, what if I want to get paid? Well, let me tell you, A, you should have a demand note that you can draw against tax-free. B, what if the beneficiaries want to get paid? Well, they don't need to be paid. The trust can cover all of their expenses. You don't just need to distribute them cash and report it with the IRS. That doesn't make any sense. Okay? And so this is truly where the 508c1a ministry trust comes into play, right? It's a private membership association, meaning that it can pay for all member expenses. Well, if you're a member, then it can pay for your food, fun, and fashion. That's the three things missing. What can the trust not pay for? Food, fun, and fashion for the trustees, the family trust. So what does the 508c1a pick up for its members? Food, fun, and fashion, because it's not required to file a tax return. It's not required to register. So it doesn't matter. It can spend money on whatever it wants to spend money on as long as it's for the members. And so let's break down the 508c1a. Now, breaking down the 508c1a, it's really crucial to understand that each and every one of our trusts are protected by Article 1, Section 10 of the Constitution, which is your right as an American to privately engage in contracts without outside interference from the state or any other interference. Now, to understand 26 U.S.C. 508c1a, we first have to look at 26 U.S.C. 501. Exemption from tax on corporations, certain trusts, etc. A. Exemption from taxation. An organization described in subsection C or D or section 401A shall be exempt from taxation under this subtitle unless such exemption is denied under section 502 or 503. Now, let's talk about the 501c3 umbrella. Everybody's heard of a 501c3. Let's break it down. 501c, list of exempt organizations. The following organizations are referred to in subsection A. 501c, let's jump down to 3. Corporations and any community chest, fund, or foundation organized and operated exclusively for religious, charitable, scientific testing for public safety, literary or educational purposes, or to foster national or international amateur sports competition, but only if no part of its activities involve the provision of athletic facilities or equipment, or for the prevention of cruelty to children or animals, no part of the net earnings of which ensures to the benefit of any private shareholder or individual, no substantial part of the activities of which is carrying on propaganda or otherwise attempting to influence legislation, except as otherwise provided in subsection H, in which does not participate in or intervene in including the publishing or distributing of statements, any political campaign on behalf of or in opposition to any candidate for public office. So, basically, any group of individuals, not a single individual, but it can operate for the benefit of a group. So that's where private membership association comes in, because it's operating for the benefit of a group. Now, let's jump to 508c1a. Now, let's take a look at 26 U.S.C. Code 508, special rules with respect to Section 501c3 organizations. New organizations must notify Secretary that they are applying for recognition of Section 501c3 status, except as provided in subsection C. Let's jump down to subsection C. Exceptions. Mandatory exceptions. Subsections A and B, these sections here, A and B, shall not apply to A. Churches, their integrated auxiliaries, and conventions or associations of churches, or any organization which is not a private foundation as defined in Section 509A, and the gross receipts of which in each taxable year are normally not more than $5,000. Exceptions by regulation. The Secretary may, by regulations, exempt to the extent and subject to such conditions as may be prescribed in such regulations from the provisions of subsection A or B or both. Educational organizations described in section 170B1A2 and any other class of organization with respect to which the Secretary determines that full compliance with the provisions of subsections A and B is not necessary to the efficient administration of the provisions of this title relating to private foundations. And finally, down to 3. So let's break this down. Section 508, C, exceptions, 1, A. Subsections A and B shall not apply to churches, their integrated auxiliaries, and conventions or associations of churches. So where our 508c1a trust fits in is right here as an association of a church. Now, you might be thinking, I'm not a church. Well, let's go ahead and take a look at what a church actually is. Taking a look at publication 557, tax exempt status for your organization. Now, page 29 of publication 557, down here under religious organizations. To determine whether an organization meets the religious purposes test of Section 501c3, the IRS maintains two basic guidelines: that the particular religious beliefs of the organization are truly and sincerely held, so long as you truly and sincerely believe whatever you are forming your private membership association upon, then the IRS will not question the doctrine that the practices and rituals associated with the organization's religious beliefs or creed aren't illegal or contrary to clearly defined public policy. The only rule is you cannot do anything that is against clearly defined public policy or cause a clear and present danger to the outside world. Again, going back to 508c1a, churches, their integrated auxiliaries, and conventions or associations of churches. We are falling into that private association. We fall into the category of the private association protected by Article 1, Section 10 of the Constitution, and your right to contract privately. Looking at IRS Publication 526, Charitable Contributions, organizations that qualify to receive deductible contributions. Examples. The following list gives some examples of qualified organizations: churches, a convention or association of churches, temples, synagogues, and mosques, association of churches. Right there, we do 100% qualify to give tax-deductible donations. Now, looking at 26 U.S.C. 6033, returns by exempt organizations. Organizations required to file, down here under 6033. 3. Exemptions from filing, mandatory exceptions. Paragraph 1. So paragraph 1, in general, shall not apply to churches, their integrated auxiliaries, and conventions or associations of churches. Private membership associations. It shall not apply to private membership associations. So not only is the 508c1a exempt from registration, it is exempt from filing a tax return, it is exempt from paying taxes, and it can give tax-deductible donations to its members. Not only that, but the IRS will not question the nature of your 508c1a so long as the doctrine and beliefs are sincerely held. So long as you're setting up this 508c1a in the name of something that you believe in, the IRS will not question it. So according to them, are they going to audit you? Are they going to come after you? Well, what they're saying is no. They're saying you're exempt from filing, you're exempt from registration, you're exempt from paying taxes, and you can give tax-deductible donations to your members. People can save money on taxes by joining your membership association. What other trust can do that? I don't know of any personally. So it's that cut and dry. Now you have everything that you need. You should, at this point, understand the tax code surrounding the trust structure that we set up. It's very cut and dry. We do not lie to the IRS. We do not try to skirt the line. We do not operate in a gray area. We do not sit around and do things that are illegal in hopes that we don't get audited. What you can and cannot do is clearly defined. And we follow those rules to a T. I'm not trying to go to jail for tax evasion, and I don't want anybody that I do business with to go to jail for tax evasion. Look, the bottom line here is that taxes are absolutely destroying hardworking Americans. And the reason that it's not destroying the wealthy is because they know the things that I just told you. They use trust. They use life insurance. They use every tool that is at their beck and call, every resource they can get their hands on to keep their money. That's how they're getting rich, by the way. They're not getting rich by giving away 30 to 35, 40, even 50% of what they make. They're getting rich by keeping what they make. And so the call to action today is to encourage Americans to keep what they earn. Let me present you with something. If you make $1 million and you want to go donate 10% to the local church, another 10% to a foundation, and you want to donate 10% to a company that's going to build the roads, fine. But do it by choice. Freedom is in choice. If there's no choices, then you are not free. And all I am presenting you with is a choice. A choice to be able to decide what happens to your money, not to have someone decide for you. I'll leave you with this. Epictetus once said, "Only the educated are free." And you, my friend, have now been educated.